Hello, I'm Simran Valecha and I've been investing in the US stock market for over 10 years now and I've made millions for myself and my clients. So if you're interested in multiplying your money before the year ends, make sure you subscribe to my channel. Today's video is about technical analysis and all the metrics I look at before deciding to invest in a company. So I use tradingview.com to do my technical analysis, but there are tons of platforms out there that can help you. So let's start with the most basic analysis of what a simple chart means. So now there are these candles here that you can see on this chart. Candles or candlesticks are a great visual representation of the fluctuations in the price of a stock. Traders use this to identify trends and estimate the direction the stock price can take in the near future. The body represents the opening and the closing prices of the stock. If it's red, then the stock closed lower than its opening price. And if it's green, then the closing price was higher than the opening price. If you are looking at a week, month, or year, a larger number of consecutive reds imply that the stock price is falling, and consecutively greens imply a steady rise in the price. The shadows above and below the body represent highs and lows during the interval. The shadows above and below the body represent highs and lows during the interval. The short upper shadow on the red candle indicates that the stock opened near the high of the interval but closed lower. On the other hand, a short upper shadow on the green candle means that the stock closed near the high of the interval. When the candle is hollow and red, the closing price is greater than the opening price, and current closing price is less than previous interval's closing price. This typically indicates a trend of price decline but with an increase in price in the current interval. When the candle is hollow and green, closing price is greater than the opening price, and current closing price is also greater than previous interval's closing price. Now there's one more dimension in these charts that I usually look for, which is the width of the candle. It represents the trading volume. If the candle's body is skinny, then it represents a low trading volume in the interval, and if it's wide, then the volume is also higher. Also, a red candle with a white body indicates a price drop where many people are selling the stock, and vice versa with green candles. Now, here are some other indexes and indicators that I use. The RSI, or the Relative Strength Index, is a momentum indicator used in technical analysis. It measures the speed and magnitude of a security's recent price changes to evaluate overvalued or undervalued conditions in the price of that security. An asset is usually considered overbought when the RSI is over 70 and oversold when it's below 30. A bullish divergence occurs when the RSI displays an oversold reading followed by a higher low that appears with lower lows in the price. This may indicate a rising bullish momentum, and a break above oversold territory could be used to trigger a new long position. A bearish divergence occurs when the RSI creates an overbought reading followed by a lower high that appears with higher highs on the price. As you can see from this chart here, a bullish divergence was identified when the RSI formed higher lows as the price formed lower lows. This was a valid signal, but divergences can be rare when a stock is in a stable long-term trend. Using flexible overbought and oversold readings will help identify more potential signals. A positive RSI reversal may take place once the RSI reaches a low that is lower than its previous low at the same time that a security's price reaches a low that is higher than its previous low price. Traders would consider this formation a bullish sign and a buy signal. Now let's consider an example here. The RSI falls into the oversold category. Then it crosses back above 30. It forms another dip without crossing back into the oversold territory. The RSI then breaks its most recent high, and this signal is called a bullish swing rejection. Now let's consider bearish swing rejection. This again has four parts as well. The RSI rises into the overbought territory. Then it crosses back below 70. It forms another high without crossing back into the overbought territory. And then it breaks into the most recent low. Now the second indicator that I use is a simple moving average. A moving average is a statistic that captures the average change in a data series over time. In finance, moving averages are often used by technical analysts to keep track of price trends for specific securities. An upward trend in a moving average might signify an upswing in the price or momentum of a security, while a downward trend would be seen as a sign of decline. A death cross occurs when a 50-day simple moving average crosses below the 200-day simple moving average. This is considered a bearish signal indicating that further losses are in store. A golden cross occurs when a short-term simple moving average breaks above the long-term simple moving average. Reinforced by high trading volumes, this can signal further gains are in store. Then the next one is a moving average convergence divergence, or MACD. This is a technical indicator to help investors identify price trends, measure trend momentums, and identify market entry points for buying or selling. Moving average convergence divergence is a trend following momentum indicator that shows the relationship between two exponential moving averages of a security's price. The MACD line is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. The signal line is a 9-period EMA of the MACD line. MACD is best used with daily averages where the traditional settings of 26, 12, 9 days are in default. The MACD is often displayed with a histogram that graphs the distance between the MACD and its signal line. If the MACD is above the signal line, the histogram will be above the MACD's baseline or zero line. If MACD is below its signal line, the histogram will be below the MACD's baseline. Traders use the MACD histogram to identify when bullish or bearish momentum is high and possibly look for overbought and oversold signals as well. Now, there is a differentiation between MACD and RSI as well. The MACD lines do not have concrete overbought and oversold levels like the RSI and other oscillator studies. Rather, they function on a relative basis. An investor or trader should focus on the level and direction of the MACD or signal lines compared with preceding price movements in the security. MACD measures the relationship between two EMAs while RSI measures price change to recent price highs and lows. These indicators are often used together to give analysts a more complete technical picture of the security they are analyzing. Now let's look at MACD crossovers as well. When MACD falls below the signal line, its bearish signal indicates that it may be time to sell. Conversely, when the MACD rises above the signal line, the sign is bullish, suggesting that the asset's price may experience an upward momentum. If the MACD crosses above its signal line after a brief downside correction within a longer term uptrend, it qualifies as a bullish confirmation and the likely continuation of the uptrend. If the MACD crosses below its signal line following a brief move higher within a longer term downtrend, traders would consider this as a bearish confirmation. What's MACD divergence now? When the MACD forms highs and lows that exceed the corresponding highs and lows on the price, it's called a divergence. A bullish divergence appears when the MACD forms two rising lows that correspond with two falling lows on the price. This is a valid bullish signal when the long-term trend is still positive. Some traders will look for bullish divergence even when the long-term trend is negative because this can signal a change in trend, although this technique is a little less reliable. When the MACD forms a series of two falling highs that correspond with two rising highs on a price, a bearish divergence has been formed. A bearish divergence that appears during a long-term bearish trend is considered confirmation that the trend is likely going to continue. Now, this is the last indicator that I look at, which is called Bollinger Bands. It's a popular tool used among investors and traders to help gauge the volatility of stocks and other securities to determine if they are over or undervalued. The center line is the stock price's 20-day simple moving average, and the upper and the lower bands are set at a certain number of standard deviations, usually two, above and below the middle line. The bands widen when the stock's price becomes more volatile and contract when it's a little more stable. Many traders see stocks as overbought as their price nears the upper band and oversold as they approach the lower band, signaling an opportune time to trade. The bands automatically widen when price volatility increases and narrow when the volatility goes down. One important reason I use this is for the trend analysis. The direction of the middle band can indicate a trend strength. When the middle band is heading upward, it suggests an uptrend, and the converse when heading downward. In addition, the width of the bands reflect market volatility. Narrow bands indicate less volatility, which means a significant price move could be imminent. This is known as the squeeze. Conversely, wide bands indicate more volatility. The bands can also help find price targets. For example, after a price bounces off the lower band, the upper band becomes a potential exit point if the price trend reverses. Likewise, after a price move that touches the upper band, the lower band becomes a possible target if a reversal occurs. It's important to note that all these indicators are lagging indicators but will help determine a trend reversal. It does, of course, take a lot of practice, but try making it a habit to look at these indicators so that you can get better at understanding what these charts mean so that you can trade using them. Now, let's consider a real life example. I'll consider the stock Eli Lilly for a 5-day period at a 1 hour interval. The solid green candles here represent that the closing price is greater than the opening price, which is a positive sign. Then we look at the RSI. It's almost close to 70, indicating an overbought sign. So I'll wait for it to fall and then look at purchasing it. With the simple moving average, you can see that it's a positive upward trend. Now, when we look at the MACD, you can see that the blue line is crossing the orange signal line right now, which means that the stock price is only going to go up. But now I'm also thinking of it in terms of the RSI. So because the RSI is so close to 70, it could easily be in the overbought territory. And this high demand for the stock could also be the reason why the price is going to go up. Finally, we look at the Bollinger Bands. They have widened, but looks like it's about to narrow, so volatility will be less. So we won't be able to trade quickly and make a quick buck. So maybe just wait in the same trading day for the RSI to fall a little below 70 and then look at investing in the stock. I do a technical and a fundamental analysis of a stock before I decide to invest in it and stay up to date with the news at all times once it's in my portfolio or in my watch list. If you want to save yourself from doing so much research on the stocks you're adding to your portfolio or watch list and still want to multiply your money, make sure you subscribe to my channel. Bye.